Hey traders, and welcome to another episode of Smart Risk. Trading without the skill to identify proper and high-quality fair value gaps can be extremely risky and may result in significant losses. Fair value gaps, often overlooked by many, represent the footprint of institutional money in the market. They play a pivotal role in executing well-informed trading opportunities and are a cornerstone in the strategies of smart money traders. In today's episode, we are diving into various candlestick fair value gap types, the psychology behind them, and the price actions associated with them that you might encounter in the market, from basic to advanced. But that's not all. We'll break down the key criteria and rules that elevate a fair value gap into a winning trade. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back traders, so let's get started. Before diving into the basic and advanced features of the fair value gaps, let's have a quick breakdown of market sentiment and see what is the main factor that fuels the market and what is the major psychology behind the market movement. The dynamics behind market movements can be boiled down to two key factors that consistently influence price direction. The first element is the liquidity zones. Market continually seeks to sweep liquidity to generate momentum. Essentially, liquidity serves as the lifeblood of the market, playing a vital role in the market's overall dynamics and functioning. We have extensively covered how to identify liquidity zones in previous videos, which you can find linked in the description. If you haven't watched it yet, you can easily access it through the description of this video. The second factor is the fair value gaps. The market consistently shows a tendency to fill and rebalance the gaps present within it. If you look at this example, you can notice that the price sharply dropped with inefficiency, leaving a fair value gap behind. Subsequently, the price moved back up and filled the fair value gap. Simultaneously, it also moved upward to clear out external liquidity. Once external liquidity was swept, the price reversed back down to fill the most recent fair value gap. This cyclical pattern reflects how the market operates, where price tends to both clear accumulated liquidity and fill fair value gaps. Now let's continue and explore how we can identify fair value gaps from the candlestick perspective in the market. Fair value gaps are typically formed within a three-candle sequence and are easily noticeable on the chart as a large candle. The distinguishing feature is that the upper and lower wicks of the neighboring candles do not completely overlap the body of the middle candle. This creates what we call the fair value gap zone, which essentially fills the space between the wicks and is drawn on the body of the middle candle. However, there is an exception in that we must consider a four-candle sequence to identify a valid fair value gap. When the first candle in a three-candle sequence is an inside bar candle and forms within the preceding mother candle, it becomes necessary to analyze a four-candle sequence to accurately identify the valid fair value gap zone. In situations like this, if we do not consider the mother candle when we are drawing the fair value gap on the chart, our identified zone will not be optimized or valid. For example, in this scenario, if we solely focus on this three-candle sequence to identify the fair value gap without taking into account the presence of this red candle, the identified fair value gap would be incorrect. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various timeframes and any price action-based chart. Now let's see what is the theory behind the fair value gaps. Consider a three-candle sequence as illustrated. Let's say that this bullish candlestick sequence, which created a significant imbalance in the market, occurred in a higher time frame. To analyze this three-candle sequence from the market structure perspective, let's zoom into a lower time frame. Here, we see that the price created a bullish structure similar to the one illustrated. As mentioned earlier, the market consistently shows a tendency to fill and rebalance the gaps present within it. Now let's take a closer look to understand the rationale behind this phenomenon. As you can see, the price created a successive bullish structure to the upside with great momentum, driven by high buying pressure and a lack of sellers in the market. When traders encounter such sharp movements and miss out on a great buying opportunity, They often place their buy limit orders below key zones, such as order blocks and demand areas, hoping that the price will make a deep pullback and activate their orders before resuming its upward movement. This scenario accumulates a lot of pending buy orders in this area, creating a significant liquidity pool awaiting to be swept by the market inside the fair value gap. So, traders' fair value gaps are filled with many buy-or-sell orders, creating a substantial liquidity pool inside the gap. This is the primary reason why the price is likely to return to fill the gaps and then continue its momentum with even greater strength. The presence of these pending orders within the fair value gap acts as a magnet for price, attracting it back to fill the void before resuming its trend. This might provide a great trading opportunity for us, but before we continue, if you're curious about how we stay updated on financial news and fundamental analysis, well, we rely on Fastbull, one of the best trading websites with various useful trading tools. This site provides one of the most accurate and detailed economic calendar, a tool we use every day before starting our technical analysis. 24/7 economic live streaming also allows us to stay informed about the latest trading world's news and fundamental analysis. So if you want to benefit from multiple trading tools that can significantly improve your trading, make sure to check the link in the description. Imagine a scenario where the price experiences a downward movement. In this case, a fair value gap, also known as a liquidity gap, emerges due to the absence of buying pressure spanning across that specific downward price movement. Please note that the identification of the gap is solely based on considering the impulse up or impulse down candle, along with the adjacent candles. Other candles outside this range do not play a role in determining the gap. These pockets of liquidity voids hold significant importance as they can serve as potent entry points due to the market's attraction to liquidity. When the price is inclined to move downward, it aims to clear the potential liquidity zones above it. Consequently, these zones become favorable regions where the price might witness an upward movement, only to eventually fill the gaps and then continue its bearish momentum with greater strength. As we understand the psychology behind the fair value gaps, now let's see how we can take advantage of them in identifying markets' upcoming movement and direction. The key factor that we can consider to determine price direction is the price action that unfolds when price enters the fair value gap. If the price respects the fair value gap and shows a rejection towards the upside, it suggests that the price will likely aim to move upward to reach the most recent buy-side liquidity, which is accumulated above the recent high. Conversely, if the price does not show a reaction upon reaching the fair value gaps, it indicates that the price is more likely to move downward to target the sell-side liquidity accumulated below the recent low. To solidify our understanding of fair value gaps, let's see how we should identify them on the chart. Consider a series of bullish candles as illustrated. Let's begin our analysis from the bottom of the candle series. Here, we have a 3-candle sequence represented by these 3 green candles. If we draw lines from the upper wick of the first candle and the lower wick of the third candle, we see a gap between them. Moving forward, we encounter another fair value gap within this subsequent 3-candle sequence. However, price subsequently experienced a downward push, ultimately filling all the gaps. In the continue, we witness a strong upward momentum in price. Now, where is our next fair value gap? By drawing lines from the upper wick of this bearish candle and the lower wick of the following green candle, we identify another fair value gap created between the candles. Next, a little bit higher, we have another 3-candle sequence. However, if we draw lines once again, we see that there is no gap between the candles, and there is no fair value gap to identify. Once again, if we consider these 3 candles and draw lines from the upper wick of the first candle and the lower wick of the last candle, we see that there was a gap between the candles, which is mitigated and rebalanced with these 2 candles. Next, we have another 3-candle sequence at the top. If we draw lines, we can easily identify another unmitigated fair value gap here. So in this bullish candle series, we have identified 2 unmitigated fair value gaps, one located at the top and one located at the extreme. The price tends to push back down once again to fill the liquidity voids in these fair value gaps and then continue its bullish momentum. Price can reverse from the upper fair value gap or it can push lower to mitigate the fair value gap at the extreme. Both scenarios could happen in the market. The same concepts can be applied to the bearish scenario. Now, let's take a quick breakdown of the real chart and see how we can utilize the fair value gap concept in market structure mapping. So here we have Euro-Dollar 1-hour chart on the screen. As you can see, price's dominant direction is bearish. For identifying fair value gaps with high probability, firstly, we need to wait for the price to form a valid break of structure. Here, we see that the price pushed to the downside and has broken the previous major low, closing below it. Thus, we have a valid break of structure. Next, let's identify potential fair value gaps resulting from the recent bearish momentum in the market. In a bearish market, it's crucial to analyze the chart from top to bottom to identify fair value gaps, whereas in a bullish market, the analysis proceeds from bottom to top. Starting from this high point, we'll begin our analysis. Here we encounter a 3-candle sequence at the market extreme. By drawing lines from the lower wick of the first candle and the upper wick of the third candle, we identify a distinct, unmitigated fair value gap situated at this extreme point. Upon closer examination of the chart, it becomes evident that there are no additional fair value gaps within this internal bearish impulse move. Now, we can see an inside bar candle pattern that formed just before the price created inefficiency in the market with this large momentum candle. As previously mentioned, in cases like this, identifying a fair value gap requires analyzing a 4-candle sequence instead of a 3-candle sequence to highlight a valid and optimized zone. Therefore, we should draw lines from the lowest point of the mother candle and the upper wick of the 4th candle to highlight the valid fair value gap. However, it's crucial to note that this fair value gap is mitigated by the price, and we cannot consider it as a trading opportunity. So inside this bearish, impulsive movement, we've identified 2 fair value gaps. One of them was mitigated by the price action, while the other remains unmitigated, located at the extreme. As previously discussed, prices are more likely to return to fill and rebalance the gaps before resuming their primary trend. Therefore, what we should do here is to wait for the price to retrace back up to fill the gaps it has left behind before continuing its bearish momentum. Let's see what happens next. As you can see, the price pushed back up again, and after filling the fair value gaps, reversed its direction and resumed its bearish momentum. Now let's move into essential criteria and rules that we need to consider to identify and use fair value gaps to execute trades in the market and understand how we can use them to our advantage. Rule number 1. It emphasizes that for considering a fair value gap for executing trades and as an entry point, the price must lead to a break of structure or a change of character in the market. Without a valid break of structure and change of character, we must not execute any trades based on fair value gaps because these elements are essential signals that indicate whether the market will continue in its initial direction or experience a reversal. Rule number 2. In a bearish market, our focus should be exclusively on fair value gaps situated in the premium zone when seeking to initiate short positions. Conversely, in a bullish market, our attention should be directed solely toward fair value gaps positioned in the discount area to execute long positions. Rule number 3. Fair value gaps situated at market extremes hold a higher priority when it comes to trade execution compared to those found elsewhere. Rule number 4. It must be unmitigated. Fair value gaps areas are considered one-time use, meaning we focus on the trading opportunity when price first enters a fair value gap. Once a FVG has been mitigated, we do not consider it as an area of interest for future trading. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.